The US market staged a dramatic rally yesterday due to potential de-escalation in the US-Iran war/conflict, where four major US benchmark stock indices rallied between 2.5% to 3.4%, with the Dow Jones Industrial Average, the Nasdaq 100, and the S&P 500 notching up their best daily gain yesterday seen in last May. However, the US dollar index continues to trade sideways, where we see a retreat at close to a 11-month sideways range resistance at 100.50. But however, the US dollar index continues to be held by its key short-term 20-day moving average. And despite that news flow that kickstart this potential de-escalation situation between US and Iran, oil prices did not fall that much, and in fact, both Brent crude and West Texas crude oil managed to hold above their key psychological $100 per barrel handle. Very good morning to all, and welcome back to another volatile session today. I'm Kelvin here. Today's daily dose will be the start of a new month, April the 1st, 2026, Wednesday. So before we kickstart the gist of today's daily dose, let's have a quick look at the disclaimer first. Leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposits. This presentation is for general information purposes and is not investment advice. Past information is not representative of future results. All right, so here we go. So let's have a recap what has taken shape yesterday in terms of the news flow, economic data release, and as well as their impact on the various key broad-based cross-asset classes. So news flow will be more pertaining to this ongoing US-Iran /war conflict, which is now coming to its 32 day. So yesterday there's some positive news pertaining to a de-escalation situation over here. So let me share with you what is the news flow. So at the around coming close to about 11:30 p.m. Singapore time, there's this media report stating that the Iranian president, bear in mind, Iranian president is not the spiritual leader, all right, is the president. So he may not be the one that has the say in terms of the ultimate outcome of this US-Iran war. So the Iranian president offered first sign of willingness to end the war with the US. So he made a remark through official state media saying that Iranian president told the EU Council President that Iran has the necessary will to end this war, but expects certain guarantees in exchange. So this guarantee over here is part of their 5 demand that is being laid out by the Iranian side, stating that the US need to guarantee the security and interests of the Iranian people. That means, i.e., they need to form some kind of agreement that they will not be attacked again by US/Israeli forces. All right, then coming close to the US session over here, Trump made a speech stating that, okay, let me expand the screen. Okay, I think the screen is frozen. Okay, good. Let me expand it so you guys could have a better view. All right, so Trump said that US will leave Iran within 2 to 3 weeks over here. And he also mentioned that it was possible that Iran could still reach a deal with the US during that time frame, means 2 to 3 weeks from today, but said an agreement with Tehran, which is the capital of Iran, was not necessary for the war to end. All right, and he also mentioned that the US had largely accomplished its military goals, and will leave it to other nations to resolve issue with the Strait of Hormuz over here. So the thing about this over here is that we know that Trump in the past is known to frequently offer 2 weeks as a potential time frame for big decision, imposing deadlines on his own administration and regularly blowing past them. All right. And what's interesting over here is that even though yesterday he gave a remark saying that 2 or 3 weeks the war and conflict with Iran could end. But in the recent days, the US Pentagon has also moved additional troops in the region. That means US military forces has been amassing. That means there has been gaining in more troop size in the past 1 week or so, preserving the possibility of future escalation if Trump changes his mind. So I would say that Trump himself still holds an element of surprise over here. And bear in mind that after this particular news flow was being announced, uh, give me a minute over here. So there was an official a statement from the press office of US President Trump stating that he will give a speech on Wednesday to update the latest status of the US/Iran war. So US President Trump will deliver a speech on Wednesday, 9 p.m. Washington time to give an update about the war in Iran. So this done by the this announced by the White House official press secretary over here. Right. So Wednesday, 9 p.m. Washington time will be tomorrow, Thursday, 9 a.m. Singapore time. All right. So between now and then, things could actually change again. All right. So, but let's take a look at what has happened in the markets right now due to this news flow. Stock market rallied over here. Still, the US stock market rallied. So still bear in mind that yesterday, for those who followed our daily dose, we flipped to a bullish bias because there are some signs of technical minor mean reversion. So all the three major US stock indices that we cover on a frequent basis, the SPX, the Nasdaq 100, the Dow Jones, so in our platform, we call it the US Wall Street 30, all hit our intermediate resistance level as they shape the expected mean reversion rebound, hitting those respective resistance level. So later I'll share with you the chart and some intermarket analysis on the major US stock indices, indicating that yesterday's rebound could be more or less due to window dressing by the end of the month, which is end of March, and also potentially quarterly dressing as well. All right, so let me share with you the headline numbers first. So the best gainers were the higher beta stock indices, where the Russell 2000 rallied by 3.4% over here, followed by the Nasdaq 100, also 3.43%. Right, then thereafter followed by the Dow Jones Industrial Average up by 2.49%, then followed by the S&P 500 up by 2.9%, then thereafter the Dow Jones Industrial Average, which is up by 2.49%. But what's interesting over here is that if we were to look at the one particular asset classes that has a tremendous driver in the last 3 to 4 weeks is oil price, because we know that oil price rising up, that causes a negative feedback loop in all risk assets. That means the global stock market or global stock indices, because of that stagflation fear narrative coming into the forefront. So if you look at the stock, the price section of the West Texas crude oil over here, which is the WTI crude, managed to hold above the $100 psychological barrier, and also managed to hold the former key medium-term swing high of 9th of March, where it did a very strong gap up rally on that particular Monday, hitting a 4-year high at 119.54, beating thereafter trading sideways. So yesterday, despite the fall of negative 3.35%, it managed to hold at the 102.25 level and holding above the $100 psychological barrier as well, and still continues to trade above the 20-day moving average. So what you could see is that the West Texas crude oil did not react so much to that news flow, stating that there could be a de-escalation between US/Israel with Iran. But in fact, oil prices are going to hold firm as well. So indicating that the stagflation risk narrative is still pretty much intact in the markets. And if you look at Brent crude as well, which is the other benchmark over here, so Brent crude will be UK oil over here. So if you look at Brent crude, it's still holding above the 20-day moving average over here, which is at $100 per barrel. All right, still holding above this 20-day moving average. So indicating that the medium-term uptrend phase for Brent crude still remains intact. Now back to the US, the FX market over here. So very quickly, let me share with you the FX market. So we know that the FX market over here, let me expand the screen. Yesterday, we see a fall in the US dollar, all right, over here at the start of the US session, all right, where that news flow came in pertaining to the potential de-escalation narrative having a forefront, which I shared with you guys earlier. But what's interesting over here is that this is the 5-day rolling performance. But as we are speaking right now in Asia, the dollar is now attempting to do a bounce. All right. So if you look at the 1-day rolling performance, right? So the dollar is now trying to bounce up from here after the fall. So the dollar is now bouncing against the Aussie and bouncing against the most against the Kiwi. All right. So the rest is rather flattish. So then if you look at the US dollar index, so what we could see over here is that oops, where is it? Yeah, this is the US dollar index. So the US dollar index continues to remain stuck within this complex sideways range. So yesterday that sell-off came in line with a retest of the upper limit of this 11-month plus of sideways range since late November last year, since late May last year, pardon me, yeah, I repeat again, but tongue twisting. So this complex sideways range configuration of the US dollar index has been in play since 29th of May, which is late May last year. So it taken into account of the current time frame is about 11 months plus. So yesterday it did a bearish reaction of the upper limit of that complex sideways range resistance 100.54. But right now during the Asia session, it's trying to bounce up from this 20-day moving average and as well as this ongoing 3 months of ascending trend line support, which is considered as a medium-term ascending trend line support since more than a month, taking into in place since the low of 27th of January, which is also the current year-to-date low, right at 99.50. So apparently there's some form of bounce back up in the US dollar in the very short-term basis today. So indicating that it hasn't broken down below the 20-day moving average, which means that the dollar index could still continues to do a bit of sideways movement and going another form of retest at the 100.10, 100.54 level again. Unless we see a breakdown below 99.50, then potentially it may drift down back towards the middle part of the complex sideways range at 99 figure level in first step, followed by 98.05. All right, so that's the situation in the US dollar index. Also still showing no sign of the total eradication of that stagflation fear, right? Which is pretty much in line with the oil prices still holding firmly above their respective 20-day moving average and the psychological $100 per barrel for the West Texas oil and the Brent crude. So now let me take you through the longer term chart of the US stock market. So bear in mind that we do not get too swayed about the strong rally that we've seen yesterday. So that rally could be due to a short covering and only a potential mean reversion rebound, but the longer term trend is still pointing more further potential downside. So how do we see that? By looking at the longer term chart. So the first, let me take you through the chart of the cash market chart of all the 4 major US stock indices. So let's start with the S&P 500. All right, so this is a very strong daily push up of the S&P 500 yesterday. This is the best daily return since May last year. Okay, if you plot the 1-day rate of change, but I'll not do that. All right. So more important issue over here is that I want to take you through the monthly chart. All right, over here. Okay, we know that's the end of the month. So this is the monthly chart. What we see is still a black bearish candlestick after a series of 3 spinning top that is being formed on December last year, January, and February this year. So this leave it a gap down over here. So this is something like a very typical bearish reaction. So it's more like a hook down over here. And some people may debate it as a monthly evening star in a way, because there's 2 star formation at the top, then before it get down. But what's interesting I want to share with you is the 3-month chart, because you know that yesterday is the end of the first quarter. So we look at the first quarter performance of the S&P 500. So 3 months, if you push it down to 3 months, so what we could see is this is a bearish candlestick, and this 3-month bearish candlestick is the most negative in terms of the price action since the start of this uptrend, or I'll say the start of this major uptrend from the low of October 2022. So bear in mind that during the fall of October 2021 all the way down to October 2022 is also due to stagflation theories, due to rising food prices having an impact on some form of the energy price as well, in terms due to the situation happening in the invasion of Ukraine and Russia. But after that, it did a major uptrend phase over here. But since the major uptrend phase started on October, the low of 2022, the 3 month, of course, this one candle one candlestick represents 3 months. So the worst 3 month period between October 2022 all the way up to this year is this quarter. All right, and this quarter, very interestingly, in terms of price action, you realize that this black candlestick covers the bullish candlestick of the previous 3 month candle. That means we're talking about October, November, December last year. So this is in fact a bearish engulfing candlestick on the longer term chart, indicating this could be a major top formation or a major bearish reversal inflection level or inflection point where the S&P has already been hit. So given the monthly bearish candlestick with the 3 month monthly bearish candlestick shaping a bearish engulfing candlestick, what it means that yesterday rally may not may be only a counter trend rebound or a mean reversion rebound to do a bit of what I call window dressing at the end of the quarter, at the end of 3/4, at the end of the month, at the end of the first quarter, because the first quarter has passed. But the bigger picture on the S&P 500 chart from a technical perspective doesn't really bode well for the longer term boost. All right. So if you look at the Nasdaq 100, very similar price action as well. Going to the monthly time frame, 1 month, we see a bearish reaction of a series of small little candlestick body previously that is formed on February, January, and December last year. And if you go to the 3 month time frame, we are able also to see a bearish engulfing candlestick as well. Over here, this is much more obvious on the Nasdaq 100. And since the start of this major uptrend phase of October 2022, this bearish candlestick down by -6% is the second worst 3 month candlestick comparatively to January 2025. All right. So also indicating that we may see a potential bearish reversal inflection point that has been formed on the Nasdaq 100, giving us a bit of clue stating that yesterday's rebound is more of a minor mean reversion rally or a counter trend rebound within a longer term time frame that the bears seems to be gaining a much more stronger foothold by looking at the price action of the monthly chart and the 3 month chart. Quickly, the Dow Jones Industrial Average. So this okay, let me show you yesterday's price action over here. If we go into 1 month price action, we also start to see a very clear shooting star, monthly shooting star that is formed on the the February candlestick. Bearish reaction candlestick, pretty much very obvious on the month of March. So what we could see over here, this is some people would deem it as a not so 100% evening star candlestick because of this small little body that is formed prior to this long bearish body candle. If you go to the 3 month time frame, okay, over here, this one is seems to form a spinning top. All right, not a bearish engulfing, but a spinning top because the candles it has a longer tail at the top, body almost the same size as the body of the prior 3 month candle, the October, November, December. So it's more like a spinning top, 3 month spinning top. The Russell 2000, the small cap, if you go to the monthly time frame, okay, it also form a bearish long black candle body. Prior to that, a shooting star, a money shooting star. So this also can be considered as not 100% evening star, because evening star we need to have a gap up in the middle candle over here. So long bullish candle followed by a small little candle, then the 100% evening top, we got to have the small little body candle gapping up the prior bullish candle, and the black candle, long black candle gap, have a gap down, right? But it's not 100% a monthly evening star, but the bearish price action of it has the same gist. If you look at the 3-month, it shaped a shooting star, a monthly, we call it gravestone doji candlestick, very similar to a shooting star as well, indicating bullish exhaustion. All right, so if you look at the longer term time frame of all the 4 major US stock indices, it seems to suggest to us that the bigger picture does not really bode well for the bulls, and in fact we may hit a major bearish reversal inflection point where there could be further weakness ahead. The next chart I'll share with you will be the market breadth of the S&P and the Nasdaq 100. All right. So this particular chart here is the market breadth. So market breadth is looking at, we can look at, we call it 52-week high, 52-week low. We also could look at percentage of component stocks with percentage of Nasdaq 100 stocks and percentage of the S&P 500 stocks holding above their various key moving average. So what we could see over here is that if you look at the 50-day moving average and the 200-day moving average of Nasdaq 100 stock, both of them are still hovering below 50%. That means a percentage of Nasdaq 100 stock above the 50-day moving average is only 21% yesterday, despite yesterday's bounce. Percentage of Nasdaq 100 stocks holding above 200-day moving average is at 43%, still below 50%, despite yesterday's strong intraday rebound. That means only a few stocks are participating in the rebound yesterday, not all the Nasdaq 100 stocks. If you look at the broader market, which is the S&P 500, that consists of 500 stocks. So the stocks percentage of S&P 500 stocks holding above their 50-day moving average is only 24%. And percentage of stocks holding above their 200-day moving average is still below 50, right? It's at 47%. All right, so net overall, we do not see a very strong participation of the component stocks in the Nasdaq 100 and the S&P 500 yesterday, because not much of, because there's still a majority of them that are still below their 250-day moving average. So that doesn't really give us a very strong bullish market breadth scenario, despite the headline numbers stating that the rally seen on the S&P 500, the Nasdaq 100, the Dow Jones is the best daily performance since May last year. All right, so that I want to share with you guys over here. So what could we see from a price action perspective is that at this point in time, there is still no clear confirmation that we have really hit a critical bullish reversal rally where the market starts to have that kind of liberation low, where it starts to see higher high and breach new all-time high. At the moment, from a technical perspective and from an intermarket perspective, looking at the US dollar index and looking at the primary driver, which is WTI crude oil price and the Brent crude oil price, still holding above the 20-day moving average, doesn't point to such major bullish reversal scenario yet for the US stock market and the global equities as per se, the global benchmark indices as per se. All right, so with that, let us now jump straight into the second segment of the daily dose, where I will cover all the intraday technical outlook on the broad-based cross asset on those broad-based cross asset classes. So with that, let me expand my screen. All right, so hopefully things are good. Yeah, okay. Now I'll start with the FX market first, which is the okay, everything is good. Good. Let's start with the euro dollar. So the euro dollar yesterday pierced above this dotted line here, which is our pullback resistance line from this former minor trend line support from the low of 13th of March. So yesterday we do have a pivotal resistance at 115.30. It broke past it, but however, right now it's trying to play around with the 20-day moving average, and it can't surpass our next resistance at 115.73. And we saw the hourly RSI has started to exit from the overbought level. So with that, we will flip to a neutrality stance for now first, given that the dollar index is still holding above their 20-day moving average, which I shared with you earlier on. So neutral between 115.73 and 115.30. Only a breakdown below 115.30 will revisit the swing low of this week and this Monday and this Tuesday at 114.55 over here. So during London session, it tried to retest 114.55 before shaping that strong bounce due to that de-escalation narrative that was being sprouted out in the global markets. Sterling dollar, very interestingly, the sterling dollar didn't actually break our pivotal resistance level. So the sterling dollar was much weaker against the USD. So the sterling dollar continues to hold below this dotted red line here, which is the former trend line support from the low of 13th of March. And it didn't, in fact, it didn't actually break above the 132.72 pivotal resistance that we have yesterday as well. So no change, watching 132.72. Maintain that bearish bias on the sterling dollar, retest below 131.80/131.60, breaking below 131.60 will expose further weakness towards 131.25 next. Next up will be the Aussie dollar. Okay, so the Aussie dollar also squeezed up over here. And what you could see over here is that it's now reintegrating back below our pivotal resistance level at 69.10. All right, at 69.10. So I will give a bit of access at 69.38 over here, which is the minor swing low of 25th of March and 26th of March. Former minor swing low of 26th of March and 25th of March. Pullback resistance, and also the 38.2% Fibo retracement of this prior down move from 18th of March all the way down to yesterday's Asia session low, all right, at 68.38 level. All right, so over here, two key support level I want you guys to watch for the intraday basis will be at 68.83. Okay, breaking below 68.83, potentially retest yesterday's swing low, and as well as Monday swing low at 68.38. Further breach below 68.38 will potentially kind of trigger off another leg of bearish impulsive down move to expose the next intermediate support zone at 67.80, 67.60. All right, only a clearance above 69.38 that would invalidate the bearish bias move to see a further mean reversion rebound scenario extending towards the 50-day moving average, and as well as the pullback resistance of this former bearish head and shoulder formation neckline support now turns into a pullback resistance at 70.15, which is very close to the psychological level. And 70.15 is the minor swing high of 24th of March and 25th of March, and as well as the upper limit of this ongoing minor descending channel since 11th of March. That's 70 figure / 70.15 over here. Next will be the dollar yen. So what I could see over here, let me share with you, the dollar yen is moving a bit of very interesting formation. So what we could see over here is that previously, oops. Okay, let me call up the RSI. I think the RSI got deleted. Never mind. Call it up again. Okay, so the dollar yen now is hovering at the previous intervention level over here, where BOJ intervened around 1.5 years or 2 years back ago at April 2024 and July 2024. And it did that bearish reaction of that intervention zone. And what's interesting over here is that the hourly RSI has shaped a bearish divergence prior to that and continues to print a lower high yesterday. Okay, indicating some form of weakness. And right now it has broke below the 20-day moving average as well. So given this longer term chart that is not so constructive for the boost of the dollar yen, we will still maintain our bearish bias on the dollar yen, which we have yesterday, where price action slide and hit our support level at 158.42/158 figure level. So it printed a low of 158.45. All right, so with that, I will have a tightened short-term pivotal resistance for today, which is the former minor swing low of 30th of March and 27th of March, and as well as 26th of March, now turns into a pullback resistance level, 159.35. So as long as 159.35 does not surpass to the upside, we will still maintain our bearish bias on the dollar yen. Breaking below 158 figure level may expose the minor swing low area of 6th of March, 10th of March, and as well as very closely 20th of March at 157.50 / 157.40. Breaking below it may revisit the 50-day moving average that is confluencing with the minor swing low area and the congestion area of 2nd of March and minor swing low area of 5th of March at 156.63. Only a bullish breakout above 159.35 will invalidate today's bearish bias move to see a squeeze up to retest yesterday's Asia session high, or which is also yesterday's day high at 159.95. Breaking above 159.95 may see a squeeze up back towards the intervention risk area again at 160.74. That's for the dollar yen. And that sum up all the 4 major US dollar pair. So now let us now proceed with the major stock indices. So for major stock indices, yesterday we were neutral with the Hong Kong 33 that is representing the Hang Seng Index. So the Hong Kong 33 did a squeeze up, now testing the upper limit of our neutrality zone and also the 20-day moving average. And right now the RSI has really hit a overbought level, all right, over here. So this overbought level, it came very close to this level here, which was previously the overbought peak on the 23rd of February. So previously when it hit this overbought peak over here, no, in fact it's this level. Yeah, let's look at around this level here. Okay, the peak of 10th of February, 23rd of February, and it's now coming close to this similar peak as well. Prior to that, the Hong Kong 33 raw price action did a bearish reaction after the hourly RSI hit this significant peak, overbought peak on the 10th of February. Similarly on the 23rd of February as well. So right now there could be a bearish reaction again, right exactly at a key graphical and mathematical resistance level, which is the 20-day moving average and the swing high area of 20th of March and 25th of March. So hence, with this observation on the hourly RSI coupled with the raw price action movement, I will flip to a bearish bias stance for today for it to mean revert down towards this sideways range configuration that has been in place since 23rd of March. So very clearly, this is kind of a sideways range that has been forming. So 25,380 short-term pivotal resistance level flip to a bearish bias. Middle part of this sideways range, which is this former minor swing high of 30th of March and 31st of March, now turns into a pullback support, 24,830 / 24,765, breaking down below this range of 24,000, this tight range of 24,830, 24,765, that could potentially revisit the lower limit of this minor sideways range that has been in place since 23rd of March, which will be at 24,257. Only a bullish breakout above 25,380 and an hourly close above it will see further extension of this mean reversion rebound to test the 200-day moving average area at 25,650, 25,800. Above it, potentially seek out the minor swing high of 17th of March and 11th of March, and as well as 3rd of March, confluencing with the 50-day moving average at this similar resistance level of 26,224. So that's for the Hong Kong 33. Next will be the Japan 225. So the Japan 225 squeeze up and hit our resistance level. So it also seems to be trading within this kind of sideways range configuration as well, but kept by this descending trend line since the high of 11th of March. So what I could see over here is that we see a series of lower high, but similar low has been formed since 23rd of March. So this could be a potential minor descending triangle range configuration with the upper limit at 53,628, which is our resistance level yesterday, where we have that mean reversion rebound. So this mean reversion rebound scenario has already met the resistance level and / 54,095, which is the upper limit of this, which is the minor descending trend line drawn from the high of 11th of March. So with that, I will flip to back to a bearish bias on the Japan 225 since it's coming to the top of the range again, and the hourly RSI is also just exited from the overbought level. So with that, 53,628, 54,095 pivotal resistance zone to watch out for, to flip to a bearish bias for today, for it to revert back down towards the middle part of the range in first step at 52,070, which is the former minor swing high of 30th of March and 31st of March. Breaking below it will revisit the all-important impending minor descending triangle range support zone at 50,630, 50,160. Only a bullish breakout above 54,095 will invalidate this bearish bias and see a further squeeze up to retest the 50-day moving average, which is also the minor swing high of 11 of March and 18 of March, confluencing at the same level at 55,130. Okay, so that's for the Japan 225. Next up will be the Germany 30, representing the German DAX. So German 30 also squeezed up, hitting our upper limit of our neutrality zone. So yesterday we turned neutral for the Germany 30 between 23,280 and 21,930, 21,830, because it's the middle part of the range. So now it will hit the top of the range. And what we could see over here is that it's now coming very close to the 20-day moving average. And what's interesting over here is that the hourly RSI also has hit a kind of a range resistance as well, coming very close to it on the 10th of February. Okay, oops, let me go down over here. Okay, so with that, we will flip to a bearish bias stance using 23,280 as my short-term pivotal resistance level. First support level to watch will be yesterday minor swing high of 30th of March, formed during the start of the US session. Now turns into a minor pullback support level, 22,630. Breaking below 22,630 may see it floating down towards the range support level zone or range support zone at 21,930/21,830. However, a bullish breakout above 23,280 and hourly close above it will see the extension of this mean reversion rebound unfolding to retest 18th of March minor swing high 23,930, followed by the pivotal resistance of 24,300 that confluence very closely with the 200-day moving average and the 50-day moving average. So that's for the Germany 30. Next will be the US Wall Street 30, representing the Dow Jones Industrial Average. So the US Wall Street 30 also squeezed up, hit our resistance level at around the 46,400 level, which we highlighted yesterday. And right now it's coming back towards the minor swing high area of 23rd of March and 25th of March. That also confluence with the 50-day and the 200-day moving average. So hence, I'll be using 46,710, 46,970 a zone, flip back to a bearish bias stance for today. Two key support level to watch will be this congestion area here that is formed yesterday, 45,940, 45,560. So a breakdown below 45,565. All right, 45,565 may kickstart another bearish impulsive down move to retest 44,975, 44,810, which is close to this Monday swing low area, and 45,565. If you were to do a trend line from the low of this Monday, okay, give it, yeah. You also confluence very closely to this trend line support as well of the low from the low of this Monday at 45,565. However, if price action don't move down and pierce up and have an hourly close above 46,970, then potentially we will see a further mean reversion rebound, testing the medium-term pivotal resistance of 46,460, which is very close to the descending trend line taken from the current all-time high of 11th of February. All right, so that's for the US Wall Street 30. Flipping back to a bearish bias using 46,710, 46,970 as my short-term pivotal resistance zone. The S&P 500. So the S&P 500 also hit our resistance level for our mean reversion rebound that take place, 6,550, and right now is coming very close to the upper limit of this descending channel drawn from the high of 26th of February. So using 6,600 as my short-term pivotal resistance level, flip back to a bearish bias. Two key support level to watch will be 6,455 today, followed by 6,388. Breaking below 6,388 may introduce another bearish impulsive down move to retest 6,327, 6,290. All right, over here, which is confluence with the lower limit of this descending channel. However, a bullish breakout above 6,600 will see a further push up towards the medium-term pivotal resistance zone, which also confluence with the 200-day moving average at 6,648, 6,705. Breaking above 6,705 will see a further rally to retest the 50-day moving average that is confluencing with the minor swing high of 11 of March at 6,795. So that's for the SPX, flipping back to a bearish bias as well, using 6,600 as my short-term pivotal resistance for today. Nasdaq 100. So the Nasdaq 100 also squeezed up as expected, hitting 23,833, which we highlighted yesterday for that mean reversion rebound. Now it's coming very close to the former minor swing low of 24th of March, where it did a bearish reaction of it on 26th of March. So this will be my pivotal resistance for today, 24,046. And if you do the Fibo retracement of the last impulsive bearish down move on a minor time scale from 25th of March high all the way down to this Tuesday Asia session low, that confluence with the 76.4 Fibo retracement. So using 24,046 short-term pivotal resistance level, flip back to a bearish bias. Two key support level to watch: 23,400 followed by 23,085. Breaking below 23,085 increase the odds of a brand new impulsive down move sequence unfolding, revisiting the swing low area of this Tuesday Asia session, 22,800/22,680 in the first step. Only a bullish breakout above 24,046 and the hourly close above it will invalidate today's bearish bias view to see a further mean reversion rebound extending towards the medium-term pivotal resistance zone at 24,355/24,537. That also confluence with the 200-day moving average and as well as this medium-term descending channel very closely, or medium-term descending resistance from the high of 28th of January 2026. Above 24,537, we'll see a much more significant, deeper squeeze up to retest the 50-day moving average that is confluencing very closely with the next graphical resistance level at 24,900. So that's for the Nasdaq 100, flipping to back to a bearish bias using short-term pivotal resistance at 24,046. Next, commodities market, starting with the gold XAU/USD. So gold yesterday, we flipped to a bullish stance. Still remember, for this mean reversion rebound to play out as it continues to trade within this bearish flag formation. So bearish flag formation is now approaching the medium-term pivotal resistance zone, which we highlighted yesterday as well, and so very close to the 20-day moving average. So with that, we will flip back to a bearish bias stance since coming very close to the top of this bearish flag at 4,736, 4,775, which is the medium-term pivotal resistance area. Two key support zone to watch will be 45.95, followed by 45.24, 4,486. All right, 4,524, 4,486, which is the range support level of 31st of March, the minor swing low of 31st of March, and as well as the lower limit of this ongoing minor bearish flag. Only breaking below 4,486 will increase the odds of another bearish impulsive down move. So that is considered as a bearish flag breakdown towards 4,319 and even retesting the 23rd of March swing low, which is the 200-day moving average, 200-day moving average as well at 4,164, 4,167, 4,099. Only a bullish breakout above 4,775 will invalidate today's bearish bias view to see a further squeeze up towards the 50-day moving average that confluence with the next key intermediate resistance zone that has been formed on 4th of March to 17th of March over here, the congestion area of 4,980, 5,009. 4,980, pardon me, 5,039. So with that, flipping to a bearish bias view on 4,736, 4,774 medium-term pivotal resistance area for gold XAU/USD. right, since it's coming to the top of the bearish flag. Lastly will be the West Texas crude oil over here. So West Texas crude oil, let me go to the hourly time frame. So yesterday, hourly time frame, initially we wanted to have a mean reversion decline to retest 96.44 slash 93.70, but price action seems to be holding pretty firmly above our first support level at 102.25, which is 102.25 yesterday. So with that, given that it's still stubbornly holding above 102.25, the bearish conviction for it to do that mean reversion decline has reduced back towards, means this probability has reduced to retest the 20-day moving average again, which is 96.44, 93.70. So my conviction to have that bearish bias view for that minor mean reversion decline is no longer intact for now. So instead, I will flip to a neutrality stance for today. So neutral between yesterday's swing high, which is Tuesday Asia session swing high at 107.11, 102.25. A breakout above 107.11 may revisit the next intermediate resistance level at 111.28, followed by the current 4-year high, which is the 9th of March swing high area this year at 116.56, 119.54. All right, so flipping to a neutrality stance for today first, but I'm watching closely the 107.11 level for a potential bullish breakout. All right, so that's for the West Texas crude oil, and that pretty much sum up the intraday technical outlook on all the broad-based cross asset classes. So before we go, let's have a quick look at the economic calendar. What other key data to look out for today? All right, so today will be the Wednesday. Okay, let me open up. Okay, good. Okay, go all the way down. Wednesday. Okay, so Wednesday, we do have tier, wait, not really a tier one job data. It's more like a tier two job data. ADP employment change, which is at 8:15 p.m. Singapore time, US. Okay, so this ADP employment change is being compiled by ADP, which is a private body, on the monthly jobs added for the US labor market over here. So market is expecting a weak number of 40K, right? So ADP employment change, so that could potentially influence the major dollar pair and the major stock indices. And at 8:30 p.m. Singapore time, you have retail sales over here. So retail sales year on year at Trading Economics is forecasting a weak number as well, 2.9% versus 3.2% that was printed in January. Right, so that could also influence the major US dollar pair, and as well as the major stock indices. Then thereafter, we have two Federal Reserve officials speaking, 9:05 p.m. Singapore time, followed by 9:13 p.m. Singapore time, Fed Musalam and Fed Bar over here. And at 10 p.m. Singapore time, we have the ISM manufacturing PMI for US for the month of March. So consensus forecast is expecting almost the same rate of expansion, 52.5 versus 52.4 that was printed previously in the month of February. All right, so market will be looking at very closely the ISM manufacturing prices. So this is considered as a leading indication of cost of doing business in the manufacturing industry for the US economy. So if manufacturing prices continues to inch up higher, so it has been going up before the start of the US-Iran war. So for the month of March, market is expecting further acceleration to 73 from February 70.5. So if this starts to hold true, the stagflation risk continues to remain at stake for the major US economy. So that is at 10 p.m. Singapore time. All right, so market will be looking at the headline number and as well as sub-component, which is the manufacturing prices, which is considered as the kind of a cost of input for the manufacturing companies in the US. Then thereafter, we will have the weekly EIA crude oil stockpile change that could have potentially as some form of a minor intraday impact on the West Texas crude oil. So that will be at 10:30 p.m. Singapore time. All right, so that's the key economic data released for today. But nevertheless, the mother of all event will be the US official press, we call it a conference, given out by US President Trump to give a speech on Wednesday regarding about the latest status or on the Iran war. All right, over here. So that will be at 9 p.m. Washington time, Wednesday. So Singapore time will be Thursday, which is the 2nd of April at 9 a.m. Singapore time, because we are kind of a 12-hour ahead of the US. All right. So with that, do practice proper risk management, as it's likely going to be a very volatile session again today, given what's at stake, especially the situation pertaining to the US-Iran war/conflict. So I'm Kelvin here, signing off. I wish you guys a great day ahead, and we shall speak again tomorrow. Thank you.